In effect, the workers are paying for it through a lower wages share. And the question is, could you eliminate that problem using an Islamic finance system? Now, what I've done to model this is say, well, let's actually model money being created not by debt, but by equity. What actually happens when you do that? And it's easy to do it in one sense, because if you think about how banks create money, and I'll talk about that again in the rest of the presentation today, they do it by extending loans, which increases their assets, and creating extra liabilities, which is the creation of money. They then charge interest for doing that, and then the borrowers can repay. That's the basic dynamics of money creation in a debt-based system. But there's no reason why you couldn't create that with an equity position. So banks could take an equity position instead. So dividends payments would then replace interest payments, therefore you have risk sharing going on. Equity cancellation would replace debt repayment, so when capitalists accumulated a large amount of profit, they could use that to pay down the banker's share. And what you get is something like this. So banks would issue money which gave them shares in the firm in return. The firm would pay dividends to the banking sector, and the firms could cancel the debt when they had large amounts of profit, larger than they wished to use for investment. So it's quite simple to imagine that shift. But having done it, so I have to, rather than looking at a debt ratio now, I now need to have a bank equity ratio, which is the bank ownership of the economy divided by the capital, value of capital. And interest payments are now replaced with dividend payments proportional to the equity that the banking system has in the economy, and therefore capitalists get the residual. And if there's funds available for investment, they're also available for equity cancellation. So you say net profit is now capitalists' share of ownership of the means of production multiplied by the gap between output and wages. And gross investment in excess of net profit now increases bank equity. And if I do that with exactly the same functions I've used for the debt-based model, I get this model. So you've now got an additional set of nonlinearities turning up here. It's exactly the same for wages share for workers, and a much more complex set of interactions on bank equity. So you might think that this would mean that there'd be a different dynamic, qualitative. There is qualitatively different dynamic, but it doesn't prevent systemic crises. Now, there's much, much more to bring in to cover Islamic finance than just risk sharing. Okay, there's also the idea of paying, redistribution of income, cancellation, delaying having to service your obligations, and so on. But I know I haven't done a full picture. But is this alone enough to prevent crises? The answer is no. I'll just show you why by putting a simulation together. So if I simulate it with the same level of parameters for the debt-based system that I showed beforehand, which gave stability there, I get a stable outcome here. I've got the wrong word there. That should be stable. But if I model it with a higher level of investment, then what you get is bank equity taking over the economy, and the same apparent moderation with a very sudden collapse. So it's the same pattern again in income inequality. With a low level of capitalist desire to invest, you get stable income shares. With a higher level, again, a falling income share going to workers is offset by a rising share going to bankers. So even though it's the firms doing the borrowing in the model, it's the workers who end up paying for it with a lower level of income share, which justifies what you talk about in terms of redistribution of income. Okay? It's a necessary part of avoiding the consequence that I'm showing here. So just having the debt showing is not enough. So just to show you that was the debt-based model I showed you a moment ago. This is the equity-based model. And again, the same story. If I put a low level here for the capitalist desire to invest, then you get equilibrium coming out of it. But if I have a higher desire to invest, and I don't need to go all that high, I'll just make it 8 rather than 10 as I did for the other case. You can see the breakdown dynamics as well. So it's not sufficient. So that's a very simple models, but I think they illustrate the power of taking a complex systems approach to modelling these type of dynamics in our economy. And you cannot get those sorts of emergent properties out of the equilibrium assessed models that neoclassicals build. So what I can show by this illustration is that what can happen just with equity, with risk sharing, without all the other elements of Islamic finance, bank ownership claims can grow faster than GDP, just as debt can grow faster than GDP. Workers will be the ones who lose out, not the capitalists until the very end. So it's not enough. You need to have all the pro-worker income distribution ideas that are part of the philosophy as well. Or you need ways to systemically reduce the bank equity share, which is the same as what I'm arguing for in the Western system, is we need a debt jubilee, what I'm calling a modern debt jubilee, to get out of the crisis we're in right now. And I think it's also partly what you'll find in the Islamic attitude towards usury, is an idea that in some way the banker's capacity to contribute to capitalism and therefore own part of capitalism is less worthy than what the capitalists themselves are doing and what the workers are doing, and that's justified. Because it's actually the simplest thing in the world, and I'll illustrate this in a moment in Minsky, the simplest thing in the world is to make money, as in actually create it. The hardest thing is to make a profit or make a wage. Okay? And particularly in the Western system with its attitude towards what bankers do and the exalted role it gives to finance, we give too much credence to the claims of the financial sector. And yet it's actually the easiest thing going to create money. So the capacity that gives them should not give them the control they can get over the system, and if they do, they'll bring the system down as well, which is what we've seen in the West. So, as I said, it's only part of what you need to answer the overall question. These are some of the other elements that you need, but we have to abandon the equilibrium approach that neoclassical economics has. Now, I might actually take a bit of a break and take some